Friends, thank you for being here today. What if I told you the Federal Reserve is quietly engineering the next great asset bubble, not out of choice, but out of necessity? And what if this single quiet pivot, born of a hidden fragility in the system, will do more to define the next decade of wealth inequality than any election or technological revolution? The American financial system is standing at the precipice of a monumental shift, a change directed not by the visible hand of the market, but by the deliberate and increasingly constrained hand of its central bank. The Federal Reserve, after a protracted campaign of monetary tightening, is executing a quiet but profound pivot. This is not merely a technical adjustment to interest rates. It is a consequential policy decision that will reverberate through every sector of the economy, from the arcane overnight lending markets to the front door of the American family home. Faced with the dual specters of persistent inflation and burgeoning financial instability, the Fed has been forced to choose its path. The decision it has now made to prioritize market stability over its inflation mandate is setting the stage for the next phase of the economic cycle, one that promises to further inflate asset prices, exacerbate the affordability crisis, and deepen the already vast chasm of wealth inequality. This new chapter began with the Federal Open Market Committee's latest decision, a 1-2 punch of monetary easing. The first and most widely expected move was a cut to the federal funds rate by a quarter of a percentage point, or 0.25%. This adjustment brings the new benchmark lending rate to a target of 4%. While significant, this rate cut was overshadowed by a far more consequential announcement. The Federal Reserve will officially conclude its balance sheet reduction program, known as quantitative tightening, or QT, effective December 1st. This single move marks the definitive end of the post-pandemic tightening era. For nearly 3 years, the central bank had been passively shrinking its massive asset portfolio, which had ballooned during the crisis by allowing bonds to mature without replacement. This termination of QT means the Fed will cease the withdrawal of liquidity that has defined its policy, halting the reduction of its still enormous $6.5 trillion balance sheet. This abrupt reversal was not born from a position of strength, but from one of growing necessity. The Fed's hand was forced by clear and present signs of stress emerging from the very plumbing of the financial system. The primary driver is a severe and accelerating drain on liquidity. This drain is being actioned through two primary mechanisms. First, the United States Treasury General Account, or TGA, effectively the government's primary checking account, has swelled by over $600 billion since the summer. As the government pulls in tax receipts or issues new debt, it vacuums cash out of the private banking system and parks it at the Fed, directly reducing the reserves available for interbank lending. Compounding this problem, the second mechanism that had been buffering the system is now failing. The Fed's reverse repo facility, or RRP, which had acted as a safety valve by absorbing excess cash, is now nearly exhausted. For months, money market funds flush with cash parked it at the RRP, but this buffer has dwindled, meaning the TGA's liquidity drain is now hitting the banking system with full force. The consequences are no longer theoretical. Short-term funding markets are becoming, in the words of analysts, very tight. The most critical barometer of this stress, the Secure Overnight Financing Rate, or SOFR, recently experienced a sharp and unnerving spike. This spike was a clear signal to the Federal Reserve that bank reserves are no longer abundant. The system has rapidly transitioned from a state of ample reserves to one of merely adequate reserves, a polite euphemism for a system dangerously close to instability. The Federal Reserve is acting preemptively because it is haunted by the ghost of a recent crisis. This pivot is a deliberate attempt to prevent a Ripocalypse 2.0. The market seizure of September 2019, when overnight repo rates spiked violently and forced the Fed into an emergency intervention, remains a fresh and painful memory for policymakers. They are determined to avoid a repeat. By ending quantitative tightening now, the Fed is choosing to stabilize the funding markets before something critical breaks, effectively trading its long-term inflation fight for short-term financial peace. This new policy stance immediately casts a shadow of uncertainty over the Fed's future path, particularly concerning its next meeting. Market expectations, as measured by Fed funds futures, have priced in an over 90% chance of another quarter-point rate cut at the December meeting. However, Federal Reserve Chair Jerome Powell has explicitly pushed back against this assumption, stating in his recent press conference that a December cut is not a foregone conclusion. He cited strongly differing views among the committee members, highlighting a growing schism within the Fed itself. Some participants reportedly believe that after 150 basis points of cuts, the current 4% rate is already within the neutral range, a theoretical rate estimated to be between 3 and 4%, that neither stimulates nor restricts the economy. These members argue that enough has been done for now. This internal division is exacerbated by a critical lack of information. An ongoing government shutdown has delayed the release of official data, most notably the September Consumer Price Index and key labor market reports. The Fed, which has repeatedly claimed to be data dependent, is now flying blind. Chair Powell aptly captured this predicament with an analogy: when driving in the fog, you slow down. This lack of visibility provides a convenient rationale for the Fed to be more cautious, potentially pausing its rate cut cycle in December to assess the impact of its pivot and wait for the statistical fog to lift. Regardless of the near-term decision in December, the long-term trajectory appears set. The quiet pivot is not a single event, but the second step in a clear three-phase process. The first phase was the initial series of rate cuts. The second phase, now official, is the termination of quantitative tightening on December 1st. The third phase, which many analysts now predict will arrive in 2026, will be the full-throated return of quantitative easing or money printing. This final phase is not expected to be a proactive measure, but a reactive one. The consensus forecast is that the Fed will keep its monetary policy in this on-hold status until something in the financial system, be it the teetering commercial real estate market, a regional bank failure, or a corporate debt crisis inevitably breaks and requires a large scale bailout. At that point, the Fed will be forced to turn the liquidity taps back on fully and decisively. These breaks in the system are not abstract possibilities. They are deep structural vulnerabilities that the Fed's own tightening cycle has exposed and dangerously exacerbated. The most prominent and dangerous of these is the commercial real estate, CRE, time bomb. The work from home revolution that followed the pandemic has permanently cratered office occupancy rates, rendering billions of dollars in office real estate assets functionally impaired. The crisis lies in the debt. Trillions of dollars in CRE loans, underwritten during the zero interest rate environment, are now sitting on bank balance sheets. A massive maturity wall of this debt is scheduled to be refinanced within the next 1 to 2 years. These loans cannot be refinanced at current interest rates of 5 or 6%, nor can they be refinanced against the collateral's new decimated valuations. This creates a no-win scenario of mass defaults. This CRE crisis flows directly into the second major vulnerability, the health of the regional banking sector. Unlike the too big to fail money center banks, regional banks hold the vast majority of this CRE debt. They are critically exposed. The failures of several regional banks in the recent past were triggered by unrealized losses on their treasury bond portfolio's assets that became impaired when the Fed raised rates. The next and potentially much larger banking crisis will not be driven by paper losses on safe assets, but by realized catastrophic losses on their core lending business in commercial real estate. The Federal Reserve is acutely aware of this. Its pivot to stop QT and cut rates is a direct, if unstated, attempt to provide oxygen to these banks, allowing them to extend and pretend these bad loans and avoid a systemic banking collapse. Finally, this vulnerability is mirrored in the corporate sector. A decade of nearly free money created a horde of zombie companies, corporations that even in good times did not generate enough profit to cover their own interest payments. These companies survived only by endlessly rolling over their debt, borrowing new money at ever cheaper rates to pay off old loans. That game has now ended. Just like their counterparts in commercial real estate, these corporations are facing their own maturity wall. They cannot refinance their junk rated debt at current high rates. The only alternative is a wave of corporate bankruptcies, which would inevitably trigger a sharp spike in the unemployment rate. This is a political and economic outcome the Federal Reserve, with its dual mandate for maximum employment, simply cannot tolerate. Therefore, the Fed's pivot is not just a reaction to esoteric stress in the overnight repo market. It is a fundamental capitulation. It is trapped between the rock of its own creation, a series of interconnected asset bubbles and debt crises, and the hard place of its inflation mandate. It has been forced to halt its tightening campaign, not because inflation is defeated, but because the real economy, built on a foundation of cheap debt, was beginning to fracture. This context makes the forecast of a massive QE program in 2026 less a prediction and more an inevitability. The Fed will be forced to act because the alternative, a systemic, multi-front deleveraging event in banks, real estate, and corporate America, is politically and economically unthinkable. This pivot toward easier money is happening against the backdrop of an inflation problem that is far from solved. The delayed September CPI report, when it finally arrived, confirmed that both headline and core inflation came in at 3.0%. This figure remains stubbornly and significantly above the Federal Reserve's mandated 2% target. Furthermore, the data shows that the progress on disinflation, which had been celebrated earlier in the year, stalled out and has in fact been reversing since its low point in April. Herein lies the central contradiction of the Fed's current policy. It is actively cutting interest rates and inflationary action at a time when inflation is already running too high and accelerating. The Fed's official rationale for this baffling move is twofold. First, it is publicly clinging to the narrative that the current inflationary pressures are temporary or transitory, a word that has returned from its 2021 disgrace. Second, the Fed is signaling that it is now more concerned with a potential weakening in the labor market, suggesting that rate cuts are necessary to preemptively support employment. This justification confirms that the Fed's primary mandate has quietly shifted away from price stability and toward ensuring market stability and economic growth. This blatant pivot in the face of persistent inflation has severely damaged the Federal Reserve's credibility. For 4 consecutive years, the Fed's own Summary of Economic Projections, or SEP, has confidently forecast that it would achieve its 2% inflation target in 2 years. This perpetually receding goalpost has become a running joke in financial circles. Just recently, Fed Governor Stephen Moran repeated the claim, projecting a timeline of 1.5 to 2 years to reach the target. The public and the markets have heard this promise before. The hollowness of this commitment was exposed in Chair Powell's recent press conference. When challenged directly by a reporter about this moving goalpost and the risk to the Fed's credibility, Powell offered a stunningly candid admission. He conceded that no one really knows where the economy will be in 3 years and that the 2-year projection is essentially just a theoretical exercise designed to show a plausible policy path that eventually returns to 2%. This admission effectively shatters the illusion of central bank omniscience and control, revealing that their long-range forecasts are less a map of the future and more a work of hopeful fiction. This disconnect between the Fed's official 2% target and the reality faced by the public is stark. A recent survey found that 75% of Americans report their monthly household expenses have risen, with a staggering 40% stating their costs have increased by $500 or more per month. When asked to identify the primary source of this pain, the overwhelming number one response was the cost of groceries. This is the on-the-ground reality of inflation, a persistent erosion of purchasing power that feels nothing like the Fed's transitory models. This public experience is likely a preview of what is to come. The forecast for a new round of quantitative easing in 2026, combined with the current rate cuts, all but guarantees that the inflation problem is not over. The consensus among critics is that the Fed's pivot will only serve to pour gasoline on the embers of inflation, leading it to come roaring back with a vengeance in the coming years. The most immediate and tangible impact of this policy shift is being felt in the American housing market, which has become a confusing and bifurcated landscape. On one hand, there is clear evidence of a slowdown. Home prices have been falling in previously hot markets, particularly across the South in states like Florida and on the West Coast. On the other hand, markets in the Midwest and Northeast have continued to see prices rise. This regional divergence creates a confusing narrative, but the national data tells a clear story. On average, home prices are still up 1.7% over the past 12 months. The most significant relief for homebuyers and owners has come from mortgage rates. After flirting with 8% in late 2023, the average 30-year fixed mortgage rate has fallen to near 6%. This decline, however, is not a direct result of the Fed's quarter-point cut. Mortgage rates are not directly tied to the Fed funds rate. Instead, they are closely correlated with the yield on the 10-year Treasury. The 10-year yield has been falling precisely because the market is front-running the Fed. It is not just anticipating future rate cuts, it is reacting to the much more powerful news of the end of quantitative tightening. With the Fed no longer selling and soon to be buying bonds, the supply-demand dynamic for treasuries has shifted, pushing yields down and pulling mortgage rates down with them. This dynamic sets the stage for a critical but likely brief opportunity in the housing market. The consensus forecast for a new massive quantitative easing cycle in 2026 is expected to push Treasury yields and thus mortgage rates to a definitive bottom. This will create a temporary refinance window lasting perhaps only a few months, where homeowners will have an opportunity to lock in what could be the lowest rates of the decade. This window, however, will slam shut. The very money printing that pushes rates down will, after a lag, trigger the next major wave of inflation. As inflation expectations shoot back up, the 10-year yield will reverse course and spike, sending mortgage rates soaring once again. For this reason, those waiting for a housing market crash akin to 2008 are likely to be disappointed. The Federal Reserve's policy of blasting on the money printers during every crisis is explicitly designed to inflate all asset prices. Housing will not be immune. The more probable outcome is not a crash, but a severe and permanent affordability crisis, one that mirrors the situations in California and New York, but becomes the national standard. In this environment, as homeownership moves further out of reach for the average family, the primary beneficiaries will be institutional investors. Large corporations flush with cheap capital are expected to continue buying up residential properties, solidifying their role as the new landlords for a generation of permanent renters. The counter-argument to this inflationary thesis has been the recent uptick in foreclosure activity. This is a valid data point, and it does suggest that the labor market is weaker than the official government reports have claimed. However, placing this data in its proper context is critical. The current level of foreclosure activity is nowhere close to the levels seen during the great financial crisis. In fact, today's foreclosure rates are not even at the pre-crisis levels of 2005. Using the 2008 crisis as a timeline is misleading. In that cycle, foreclosures began to spike years before the market finally bottomed out in 2012. For those waiting for a foreclosure-driven crash to buy a home, they could be waiting 8 to 9 years. By that time, after the Fed has unleashed another multi-trillion-dollar QE program, home prices, even after a potential correction, will almost certainly be much higher than they are today. This housing market dynamic is a microcosm of a much larger and more troubling trend: the role of Federal Reserve policy in driving wealth inequality. The Fed's easing cycle is a blunt instrument, and its benefits are not distributed equally. The primary beneficiaries of lower interest rates and high liquidity are unequivocally those who already own financial assets. This group is overwhelmingly composed of the wealthy, older generations, and large corporations. The data is staggering. The top 0.1% of the population has seen its collective wealth nearly double since 2020, with virtually all of that growth coming from gains in the stock market. The S&P 500 is hovering near all-time record highs, and the year 2025 is on track to see a record $1.25 trillion flow into exchange-traded funds, or ETFs, as retail and institutional investors alike chase the rally. The mechanism by which this gap widens is a direct and intentional consequence of Fed policy. It is often called the search for yield. When the Fed conducts quantitative easing, it buys safe assets like Treasury bonds. This massive purchasing pressure pushes the price of these bonds up and their yield down. This makes safe, income-generating assets far less lucrative. This policy forces investors, from large pension funds to retirees, to find a better return on their capital. This creates a waterfall effect as trillions of dollars, including the $7.5 trillion currently sitting in money market funds, are pushed out of safe, low-yield assets and flow downhill into riskier ones. This flood of capital creates frothiness across the entire asset spectrum. The first stop is the public stock market, inflating the S&P 500. As that market becomes crowded, the money continues to flow into even riskier and more exclusive assets like private equity, private credit, and alternative markets such as Bitcoin and gold. This entire cascade is the intended result. The Fed's policy is designed to inflate asset values, creating a wealth effect that it hopes will trickle down to the real economy. Simultaneously, the largest corporations, such as Apple, reap the greatest benefits. They can borrow at the cheapest possible rates, using that capital for internal investment, capital expenditures, or, more often, stock buybacks that further enrich their shareholders and executives. On the other side of this equation are the groups who are actively hurt by this policy. The wage earner class, particularly younger generations, are disproportionately damaged. Younger households, by definition, have had less time to accumulate assets. Their financial lives depend more on wages than capital gains, and they own the smallest share of financial assets. They are net savers, not net investors. When the Federal Reserve cuts interest rates to zero, the interest earned on cash in a simple savings account collapses. This policy acts as a saver's penalty, punishing thrift and forcing young people to either participate in the risk asset casino or watch their savings be eaten alive by inflation. The most significant and life altering impact of this policy, as discussed, is the housing lockout. The asset inflation that benefits older generations directly translates into an affordability crisis for the young. The comparison is stark. In 2006, the median household income was approximately $58,000, and that household needed an income of $54,000 to qualify for a median priced mortgage. Today, qualifying for a median priced home requires a six-figure household income, far above the current median. The Fed's policy of inflating assets has locked younger buyers out of the primary mechanism for middle-class wealth creation. Finally, these lower income and younger households are hit twice. First, they miss out entirely on the asset boom that enriches the wealthy. Second, they are disproportionately affected by the consumer price inflation that is the inevitable byproduct of the same monetary easing. They pay higher prices for groceries, gas, and rent, while their wages fail to keep pace and their savings earn nothing. The Federal Reserve's quiet pivot, therefore, is far more than a technical maneuver. It is a profound social and economic choice. Trapped between the immediate, acute danger of a financial market seizure and the chronic corrosive disease of inflation, the Fed has made its decision. It has chosen to stabilize the markets and protect the asset-based economy. The cost of this decision, however, will be paid by others, by savers, by wage earners, and by a younger generation that finds the ladder of economic mobility pulled ever further from its grasp. The coming years of managed markets and the inevitable return of quantitative easing will not just define the financial landscape, but will actively shape a new American economy defined by permanently high asset prices, persistent inflation, and a deep structural divide between owners and renters, between the asset rich and the asset poor.